Wouldn't everyone like to know what the stock market is going to do in the future? Merrill Lynch has a pretty good guess. I'm Jack Otter, editor of Barron's.com. I'm here with Pat Dwyer, a private wealth manager at Merrill Lynch. So your technical number cruncher, quantitative guys have put everything into a formula, and what'd they come out with?
Well, I'll tell you, we have two different points of view at our shop, and they're good to great. We think we entered a secular bull market in 2013, and really what that means is, secular bear markets usually last, sort of 10 to 15 years, and we broke out of a secular bear market in 2013 when we kind of busted through 1550 on the S&P, and we think now we're in a longer-term period where the S&P is going to go a lot higher. Our quantitative folks think that the S&P 500 has a very high probability, about a 90% probability of hitting 3,500 by 2025, and so that would give you a total return if you held the S&P 500 over the next 10 years of about 9%, appreciation plus dividends. Our technical analysts think that the market could go as high as 5,500 over that same time period or a little longer. That's typically what happens in a secular bull. So we're pretty optimistic about equities. Unfortunately, we're not as optimistic about the other asset classes. So stocks, we think, are really the only game in town for long-term investors.
So to get 9% a year, one of two things has to happen. Either earnings have to ramp up or investors' willingness to pay more for those earnings has to increase. In other words, multiples go higher. Is it both of those, one of those that gets us to that higher number?
Well, really only one thing has to happen. People have to buy stocks. and really asset classes compete with each other. So, when you talk about valuations and such, you can't look at valuations, stocks compared to where they were historically, because you have to compare stocks to cash, to bonds, and to real estate. Those are your choices. We feel that higher quality stocks, blue chip stocks, are going to be in a bull market. We do not feel the same way about lower quality stocks. So what I'm really saying is that we think that valuations will probably re-rate higher as investors begin to pay more of a premium for those companies that can deliver solid and consistent earnings, that have free cash flow, that are high quality, that aren't going to go out of business because of a new app. And we think investors will do what they've always done, which is underprice an asset class and then overprice an asset class over a long period of time. So I would imagine that we'll finish the next 10 years with stocks trading at really, really high valuations that we were at the end of the last 1999, and we were in the high 20s. I don't think I think that'll happen again. I think it'll happen again.
Well, before it happens, you and I will shoot another video and you will warn viewers what's going to happen. But in the meantime, there are a couple of sectors that you like particularly right now. Let's start with healthcare.
Sure. So I think, when you're looking at the market overall, I think you want to have some S&P exposure for sure, because if you think the S&P is going to go to 3,500, that's a bet you should make. And we would do that in a tax-efficient way. But I also think you have to look inside your asset allocation and say, hey, you know what? I'm not going to have the safety in my bonds that I've had historically, because when the next time we have a recession, bonds aren't going to appreciate as much as they have historically. So I think you have to think about your equities and be a little bit more conservative than perhaps you would historically in what you own. Because if there is, and there will be, of course, recessions and so forth, you want to be protected. Having said that, I would be looking at starting to overweight some sectors of the market that are undervalued and are out of favor. One of those is healthcare. Ever since Hillary put out her first tweet, healthcare stocks have been under pressure. Healthcare stocks and that sector in general has had the most positive earnings surprises of any sector over the last 12 months. They have the best free cash flow. It's one of the only places where you can raise prices. I mean, prices are going up 6% there. Where else are prices going up 6%? And obviously, the long-term trend for healthcare is tremendous as the world gets older. The demand for drugs and for services, healthcare services, is only going to grow, not just in the United States, but especially in the emerging markets. As soon as people have wealth, the first thing they do is trade up their healthcare. So very bullish about healthcare longer term. You can buy the healthcare sector at 15, 16 times earnings right now, which is really, really cheap. And I don't think there's any momentum there. There's no momentum there at all. It's not a place where you're going to make great returns in the short run, but I think if you're a long-term investor, this is a defensive part of the market that you should be adding to.
The indexes, the healthcare indexes, had a good run post-Obamacare until, as you said, Hillary sent out that tweet. And historically, Hillary Care, great time to buy healthcare. Obamacare passing, great time to buy healthcare. So when you have these political pressures, often I think we overshoot on the downside and you have a buying opportunity. Right.
And the reason why I think that, particularly for healthcare and particularly for drug stocks, if you look at healthcare expenditures, right, for the 80% of healthcare costs are in hospital costs. 20% are drugs. The problem is, politically, the part that we all see is the drug cost, because that's what we see when we go to the CVS or wherever. So we see that part, so that's the most politically, but politicians know that if you cut off the supply of great new drugs, you're increasing the cost in the hospital, right? Because these drugs keep us out of the hospital, which is where 80% of the costs are. So I think at the end of the day, cooler heads will prevail, and drug companies will be allowed to earn an appropriate profit in order to pay for the research and development we all need in order to live longer and healthier lives.
One more sector, and that's technology. You see some opportunities there. Can you explain?
Yeah, we do. Tech is not as cheap, obviously. Tech's had a decent run this year. It was a little out of favor at the beginning of the year. But again, technology is a very high-quality space. They make a product that everybody needs to buy. Now, whether we have a recession or don't have a recession or growth is strong or slow, companies are going to continue to invest in tech to keep their costs down. So the demand for that product is very high. The companies in the business are trading at very reasonable valuations, except for the social media stocks, which I'm not including in that group. And the cash flow is terrific, and they're not leveraged. They're not leveraged. So this is a space where when times are tough, they're in a great position to get through them, and there's true demand for their products, innovation happening, and it's also another sector where, guess what? America leads.
Is this something you can index, or do you prefer stock picking in that area?
The last 7 years, our research has been suggesting that it's not a stock picker's market, that it's been a very difficult time to pick individual stocks, and you've been better off broadly investing in indexes and or investing in sectors. I still think that because it hasn't paid to own individual stocks, you should be in sectors, but the market's beginning to change. And I think what you're beginning to see is that we're moving into the second phase, getting a little bit closer to getting back to what I would call a stock picker's market, where there's real differentiation in stocks in the same sector, but we're not there yet. And so I would stick with ETFs. I would stick with a healthcare ETF. I'd stick with a tech ETF for now. And then I think probably in a year or two, the cyclical winds will change, and I think you'll begin to have to start to pick individual stocks.
Thanks very much, Pat.
Thank you.